Hey guys, welcome back to Flow State Finance. My name's Arnav, and today we're going to be talking about the balance sheet. Let's get started.
The balance sheet is like a high-definition picture of the numbers. You can think of it as a financial snapshot because it tells you how a company is doing at a specific point in time. This analogy might be unclear at the moment, but keep it in mind, and as we go through the video, hopefully your understanding of the balance sheet will be developed to the point where it makes sense. In this video, we will first present a basic definition of the balance sheet. After that, we will break down a sample balance sheet so you can see what each individual component looks like in an idealized form. Then, we'll explore a real-world example to help you connect those conceptual ideas to a more real-world context. And then finally, we'll wrap up with a review of key ideas. First, let's go over the definition of the balance sheet. What is a balance sheet? Well, a balance sheet is one of three core financial documents that shows a company's assets, liabilities, and shareholders' equity at a specific point in time. That last phrase, specific point in time, keep that in mind when you think about the balance sheet because that's its defining feature. So while an income statement measures a company's performance over a period of time, the balance sheet is the opposite. It's a snapshot of a company's financial status at a specific point in time. Let's take a look at a sample to help solidify your understanding of the balance sheet. But first, before we dive into it, we must go over some financial jargon that will be fundamental to our discussion later on. I don't want to overcomplicate anything in this video, so we'll just go over a few relatively simple ideas to start. First, we have liquidity. That is a measure of how quickly a financial asset can be converted into cash. Remember that a financial asset is anything that holds a standardized, regulated monetary value, so things like owning gold, a car, a house, stocks, all of those are financial assets. Liquidity, then, is how quickly an asset can be converted into cash. Stocks are considered liquid assets because they can be sold for cash at pretty much any time. Now, obviously, it's easiest when the stock market is open, but it's open very regularly, and you can also trade on the weekends. So if you own stock, the chances are you can sell it within 24 hours, which is pretty quick. That's why we consider stocks to be liquid. On the other hand, assets that take a long time to be converted into cash are considered illiquid, like a house, for example. Houses can go unsold for many months, and even when they are sold, the process to finalize a sale can take a while, so they're considered illiquid. Next, we have the term security, which is a financial instrument that has a certain monetary value. You may not have heard the term security, but you've probably heard of stocks, bonds, or options, which are all examples of securities. So when you hear security in a finance context, just think of stocks, bonds, or options. The third important idea is deferral, and we'll be talking about it from an accounting perspective. In everyday use, deferral means to put something off or to postpone it, and it has a similar meaning in accounting. Deferred revenue is revenue that is due to a business at a later date, so the business is entitled to that money later. On the other hand, we have deferred expenses, which are expenses a company must pay at a later date. In this case, the company owes the money to another entity. If you're having trouble remembering the difference between deferred revenue and deferred expense, think of it like this. A company's revenue is money that it makes, so deferred revenue is money that it will make later. Similarly, a company's expenses are money that it has to pay, so deferred expenses are money that it has to pay later. Hopefully, thinking of it that way will help you keep your definition straight. Now, the final note before we go on to the sample balance sheet is the following, and it's an important one. The balance sheet must always be balanced. This is the equation that it must always follow. Assets equals liabilities plus equity. Now you can rewrite this in several ways, so you might see assets minus liabilities equals equity, or assets minus equity equals liabilities, but the core principle is the same. Just remember, assets equals liabilities plus equity. Now you might have noticed that I said equity instead of shareholders' equity, but just know that in the context of the balance sheet, those terms are interchangeable. So if you hear me say equity instead of shareholders' equity and vice versa, just know that they mean the same thing. Alright, now that we've got that out of the way, let's take a look at a sample balance sheet. So again, make sure that you remember that the balance sheet is broken into three sections: assets, liabilities, and shareholders' equity. The one we'll be looking at today is the balance sheet of a fictional company called Teddy Fab Inc. for the date December 1st, 2100. This sample comes courtesy of FreshBooks as part of their instructional material, and I chose it because of how simple and straightforward it is. Let's get started. First, we have the assets category, which is a breakdown of the monetary value of everything a company owns. The current assets section is typically the first section of assets on a balance sheet, and it includes a company's most liquid assets. In this sample, we can see line items like cash and cash equivalents and inventory, which are good examples of liquid assets. Next, we have the property and equipment category, which, true to its very descriptive name, has all of the long-term assets of the company. Things like land and equipment are difficult to sell on short notice, so they fall under this category. However, this is generally true for smaller companies. If you think of a big corporation like Amazon, for example, and its many warehouses, they probably have millions of goods that they move through any one warehouse in a given week. So, for example, if a warehouse cost $5 million and Amazon moves $10 million worth of goods through it in a month, the value of the goods in that warehouse far outweighs the long-term usefulness of the warehouse itself. So their current assets are far more valuable than their long-term assets. On the other hand, if a new company bought a $10 million warehouse, it might take them many months or even years to get that much use out of it. So the warehouse as a long-term asset would be worth more than their current assets. Next, we have other assets, which is a catch-all category for all the miscellaneous intangible assets owned by a company. Things like patents and copyrights would be located here. The final thing on the left side is total assets, which is the total monetary value of all of a company's assets. In this case, the total assets value for Teddy Fab Inc. is $472,100. Switching over to the right side, we have liabilities, which are the exact opposite of assets. They are what the company owes. Like assets, they can also be split into current and long-term categories. Current liabilities are the financial obligations of a company in the short term, like electricity bills or employee salaries, while long-term liabilities are financial obligations owed down the road, such as a business loan owed to a bank or something along those lines. And then finally, we have shareholders' equity, which is the part of the company actually owned, both publicly and privately, by individuals. It includes the retained earnings, common stock, and any other capital that's paid by investors to acquire stock. Just as a quick note, retained earnings are just the earnings left over after a business has paid dividends to its shareholders. So if you take net profit and subtract dividends, you're left with retained earnings. Shareholders' equity also contains treasury stock, which is the term for stock that has been bought back from shareholders by the issuing company. So if Teddy Fab Inc., our hypothetical company here, decided that shareholders owned too much of their company, they could buy back the stock from them and then it would be counted as treasury stock. As you can see in this sample, the big idea at play here is that when you add up the value of all of your assets on the left, you get a figure of $472,100. And when you add up all of your liabilities and shareholders' equity on the right, you also get $472,100. So we can see a good example of just how the balance sheet is supposed to balance. Alright, now that we have a good idea of what a balance sheet looks like in theory, let's apply those ideas to a real-world example. In this video, we'll be taking a look at Tesla's consolidated balance sheet, which, as you can see, is for the fiscal year ending on December 31st, 2019. Let's go over each of the three key sections in detail. First, we have the assets section. As you can see, just like it was in the sample, Tesla helpfully includes a categorical breakdown of their assets, which the balance sheet tells us totaled $34,309 million, or $34.3 billion. Of those $34.3 billion, $12.1 billion are current assets, while long-term assets make up another sizable chunk. Finally, we have the other assets category, which is the smallest portion of the assets section and includes intangible assets like copyrights and patents. Next, we have liabilities. Like the assets section, current liabilities are also designated under their own section of the document, while long-term liabilities are just underneath those. Near the bottom of this section is the total liabilities line item, which tells us that in 2019, Tesla had roughly $26.2 billion of liabilities. Finally, we have equity. As you can see, shareholders' equity, or in this case, they call it stockholders' equity, makes up the majority of this section. Additional paid-in capital is the largest portion of this section, and that's essentially the value of money shareholders have invested to buy Tesla stock for the 2019 fiscal year. So if you look at this portion of the document, the final line should jump out at you, and that's the section called Total Liabilities and Equity. If that number seems familiar, that's probably because it matches the value of total assets we discussed previously. So here it is. Total assets is $34.3 billion, and total liabilities and equity is also $34.3 billion. So as we can see, the balance sheet balances. It follows the fundamental equation of assets equals liability plus shareholders' equity. Now that we've gone over everything, let's review some key ideas to make sure you've got the picture. So first, make sure that you understand that a balance sheet is a snapshot of a company's financial holdings. And the key equation that drives this document is assets equals liabilities plus shareholders' equity. Next, we have some key terms. Liquidity is a measure of how easily an asset can be converted into cash. Remember, stocks are liquid while houses are not. A security is a financial instrument that has a monetary value. When you think security, think stocks, bonds, or options. Deferred revenue is money owed to you. You can also think of it as money you will get later. On the other hand, deferred expense is money that you owe, or a cost that you have to pay later. Next, looking at the balance sheet itself, you should know that assets are broken into current assets and long-term assets. Current assets are short-term and liquid, like cash or inventory that can be sold to earn cash. Long-term assets, as the name suggests, are illiquid, like a warehouse or a plot of land, and are typically things a business will use over an extended period of time. Liabilities are also broken into current and long-term liabilities. Current liabilities is the category of cost that a company has to pay in the short term, like employee salaries or the electricity bill, while long-term liabilities are obligations a company has to pay over a long time, like a debt owed to a bank that might be collected over many years. And then we have the final section of the balance sheet, shareholders' equity. Shareholders' equity, or equity, is made up of four main sections: retained earnings, additional paid-in capital, Treasury stock, and shares outstanding. Retained earnings are found by subtracting dividends from net income. Additional paid-in capital is essentially the amount of money investors have paid to acquire a company's stock. Treasury stock is stock that a company buys back from its shareholders. And finally, we have shares outstanding, which is the value of all of a company's shares still available for investors to buy. If you remember these key ideas, you'll have a pretty full-featured understanding of the balance sheet.
That's all for today. I hope you learned something new, and if you did, be sure to like, subscribe, and share this video with your friends. Also, if you're interested in learning about some of the other finance topics I've covered on this channel, be sure to check out the videos linked in the description below. Thank you for learning with Flow State Finance.